Everyone remembers September 2008, Lehman Brothers, the market crash, the panic. What nobody talks about is when the S&P peaked the year before. 18 months before Lehman failed, the data was screaming warnings for over a year. Credit spreads were blowing out. Housing was falling apart. The yield curve had inverted, but the market kept going up until it didn't. And when it finally turned, it fell by more than half. If you understood the sequence, you had 18 months to get defensive. If you waited for certainty, you paid the full price. But here's what really gets me. I was there. I was watching the credit default swap indexes explode higher, while CNBC was calling new highs. I watched the mortgage index collapse while real estate agents were still saying prices only go up. The information was public. The warnings were clear. Most people just chose to ignore them because they were making money. Hey, welcome back to The Recessionist. I'm Tom. And if you think 2008 can't happen again, you're about to learn why you're wrong. If you've been following this channel, you know we've been tracking the early warning signals since the model launched. We flagged the Bitcoin crash before it dropped a third, called the jobs overcount months before the government admitted they were wrong by hundreds of thousands. The defensive portfolio has been quietly beating the market while taking less risk. And just last week, subscribers got the alert before the VIX spike that caught everyone else off guard. Today, the recession risk score sits at 67 out of 100. Pre-recession phase up sharply just this week as market anxiety spiked hard. And the reason I'm talking about 2008 isn't nostalgia. It's because several of the same mechanisms that broke the financial system 18 years ago are active right now. The leverage is different, the assets are different, but the sequence is identical. Credit conditions tighten first, then liquidity dries up, then something breaks, and when it breaks fast. We're in stage one right now. Most people are focused on the stock market hitting new highs. They're missing the credit market flashing red. So let me tell you what actually happened in 2008, because the story you know is wrong. Most people think it was a sudden crash, black swan, nobody saw it coming. That's complete bullshit. The crisis unfolded in 3 phases over 2 years. Each phase had measurable signals, clear warnings, opportunities to get out. Phase 1 started in 2006. Housing peaked. By early 2007, home prices were falling nationally for the first time since the Great Depression. Subprime mortgage delinquencies doubled. Credit default swaps on mortgage bonds started blowing out. The mortgage bond index went from par to pennies on the dollar. But here's the key. Equity investors ignored it completely. The credit markets were screaming. The stock market was partying. I remember sitting in meetings where credit traders were panicking and equity guys were talking about new highs. That gap between credit stress and equity complacency, that's the textbook early warning. Credit leads equities by months at major turning points, always has, always will. Because credit investors lend money, they get their principal back or they don't. Equity investors are betting on growth stories. They can rationalize anything until they can't. The phase 2 was the liquidity freeze. This is where most people's memory gets fuzzy. Bear Stearns liquidated 2 massive hedge funds, combined assets worth tens of billions gone. The Fed started cutting rates aggressively, multiple cuts over months, but it didn't matter. The banking stress indicators exploded. Banks wouldn't lend to each other at all. Overnight, the commercial paper market seized up. Asset-backed commercial paper fell by hundreds of billions in months. Bear Stearns itself got bought for scraps. Stock was trading at incredible highs a year earlier. The market rallied on the news. Everyone called the bottom. Jim Cramer said the worst was over. They were wrong by over a year and dozens of percentage points, and that's the lesson nobody wants to hear. Getting the timing exactly right doesn't matter if you understand the sequence. Credit spreads widen first. Then the yield curve inverts. Then housing falls apart. Then unemployment starts climbing. Equities are second to last. The dollar usually strengthens as foreign capital flees to safety. By the time the stock market confirms the recession, you've missed your window to get defensive. Phase 3 was the systemic collapse. This is the part everyone remembers because it happened fast and it was visible. Lehman filed bankruptcy with massive assets, biggest in history, but what most people don't know is that Lehman was shopping for a buyer for months. The UK blocked buyers, Bank of America chose others instead. The government decided not to bail them out. That decision almost broke the entire global financial system within hours. A major money market fund broke the buck because they held Lehman paper. That triggered a run on money markets. Hundreds of billions pulled out in days. The Treasury had to step in with emergency guarantees. The entire shadow banking system was collapsing in real time. The VIX spiked to levels that have never been matched since, not even during COVID when the entire world shut down. Investment-grade credit spreads hit depression levels. High yield hit even worse numbers. Default rates priced for economic catastrophe. Here's what broke everything. Leverage, the big investment banks were running extreme leverage ratios. That means a small decline in asset values wiped out their entire equity base. Bear Stearns, Merrill Lynch, Lehman, they were all walking time bombs. Leverage is the accelerant, not the cause, but it turns a manageable problem into a systemic crisis. So what does 2008 teach us about right now? 3 things. And pay attention, because this is where most people get it wrong. First, correlation goes to 1 in a crisis. Your diversified portfolio isn't diversified when it matters most. In the crisis, REITs got destroyed, high-yield bonds lost massively, emerging markets collapsed, international developed markets fell hard, even investment-grade corporates lost money as spreads widened, commodities got crushed, gold fell sharply as margin calls forced liquidation. The only things that worked were treasuries, FDIC deposits, and cash. Everything else got sold. I don't care if you're holding stocks and bonds. I don't care if you're diversified across sectors and geographies. When the system breaks, everything moves together. Second, the sequence is predictable. We're seeing it play out in real time. Credit conditions are tightening not in corporate bonds yet, but in commercial real estate. Office building values down massively in major cities. Regional banks loaded with CRE exposure. The yield curve uninverted, but spreads are still compressed. That's not healthy normalization. That's late cycle flattening. Housing affordability is at extreme levels. Worse than 2006 in many markets, labor market is showing stall speed, barely any jobs being created. That's not expansion, that's stagnation. Third, leverage amplifies everything. Corporate debt is near all-time highs. Share buybacks funded by borrowing. Private equity loaded with leverage buying companies at ridiculous multiples. Household debt service ratios climbing as rates stay elevated. Credit card debt at records. Auto loans at record levels. When the cycle turns, the leverage unwinds fast. And it breaks things that looked bulletproof. And here's what the model is seeing right now that matches the 2008 playbook. Market anxiety is spiking hard. The VIX jumped sharply in days. That's a massive increase in fear. Oil's creeping higher, putting pressure on inflation expectations. Consumer sentiment falling as people pull back. Spending, the sentiment index dropped significantly. That's a major move. Unemployment is creeping higher. The trend is in the wrong direction. Unemployment ticked up meaningfully. That's a significant increase. The recession indicator is approaching the danger zone. Above the threshold has never failed to signal a recession. The yield curve uninverted, which sounds good, but look closer. That's not gradual normalization. That's violent. Steepening driven by long-term rate volatility. The labor market is at stall speed. Job creation has basically stopped when you look at the adjustments. The government had to revise down last year's numbers by hundreds of thousands. That's not a rounding error. That's a measurement failure that suggests the job market was weaker than reported for months, and continuing claims are rising, people staying unemployed longer. That's up significantly from the lows. That's the early stage of labor market deterioration. People aren't finding new jobs as quickly. So how does this play out? I see 3 paths. And I want to give you probabilities because vague predictions are useless. Path 1 is the soft landing. Low probability, the Fed threads the needle. Inflation comes down without breaking employment. Credit conditions ease as the Fed cuts rates. Markets rally into year-end. Recession risk falls back significantly. Tech earnings surprise to the upside. Consumer spending stabilizes. That's possible. The yield curve uninversion is a positive signal. Services inflation is moderating. The consumer is still spending, just more selectively. Path 2 is the slow burn, high probability. Economy weakens gradually over months. Unemployment drifts higher. Corporate earnings disappoint as margins compress. Markets chop sideways with much higher volatility. Recession in late 2026 or early 2027. Moderate duration and peak unemployment. That's the model's base case right now. It matches the leading indicators: credit stress building but not breaking, labor market cooling but not collapsing. Path 3 is the credit event, lower probability but rising. Something breaks in the next 6 months. Regional bank fails due to commercial real estate losses. Leveraged loan market seizes up. Credit spreads blow out like 2008. High yield goes from manageable to panic levels in weeks. Recession within months. Markets fall dramatically. Unemployment spikes within a year. Based on current leverage levels and credit conditions, this path is more likely than most people think. The trigger could be commercial real estate, could be a leveraged buyout that goes bad, could be a foreign bank with U.S. exposure. The kindling is dry. We just need a spark. So what does this mean for your money? Be specific here. If you're sitting in index funds thinking you're diversified, you're making a concentrated bet on a handful of stocks. The big tech names make up a third of the S&P 500. When correlation goes to 1, those all move together. Down. If you own QQQ, you're even more concentrated. Top holdings are over half the fund. If you're carrying debt, the window to refinance or pay down is closing fast. Mortgage rates are stuck high. Credit card rates are at extreme levels. Personal loan rates hitting painful levels. If unemployment rises and your income gets cut, servicing that debt gets exponentially harder. I've seen people lose houses because they couldn't make payments that were manageable when they had jobs. If you're house hunting, affordability is at extreme levels not seen since 2006. Mortgage payments are eating nearly half of median income in major cities. In expensive markets, it's even worse. That's not sustainable. A recession typically drops home prices significantly. More in overvalued markets. Some cities fell by more than half from peak to trough. If you're holding cash, you're positioned for opportunity but losing purchasing power. High-yield savings and money markets at decent levels. Inflation still running above target. You're losing money in real terms. But when the market falls dramatically, cash becomes your best friend. Not because it goes up, because it doesn't go down, and because it gives you options to buy assets at distressed prices. I remain defensive, and I'm increasing that stance. High cash allocation as of last week, reduced equity exposure significantly, long duration treasury allocation maintained, same basic posture I've held since launching the model, but more extreme. The 18-month forecast shows the slow burn scenario as most likely, gradual weakening through 2026, higher volatility, recession probability rising through the back half of 2026, peaking in Q4. That's not a crash prediction, that's a risk management framework based on leading indicators. The model has been right about the trajectory. It called the labor market slowdown months early, it flagged the credit stress before it showed up in spreads. If you want to track this stuff in real time instead of waiting for YouTube videos, I built a full dashboard, indicators updated daily, rolling forecast, sector rotation signals, portfolio allocation guidance. Here's specifically what I'm watching in March. The jobs report, if job creation stays weak, that confirms stall speed and pushes the model higher. Watch the Fed meeting. If they cut rates with core inflation still elevated, that signals they're more worried about growth than inflation. Both of those data points would push the model above 70, firmly in recession warning territory. I'm also watching the regional bank earnings in April. Commercial real estate losses could be the trigger for credit stress. Look, I want to be clear about something. Nobody wants a recession. This isn't some apocalyptic fantasy. Real people lose jobs. Families struggle. Retirement accounts get cut in half. Small businesses close permanently. That's not abstract economic data. That's somebody's dad getting laid off. Somebody's mom's retirement getting delayed by years. Somebody's kid's college fund disappearing. I lived through 2008. I watched friends lose houses. I watched careers get destroyed. It's brutal and it's personal, but pretending the risks don't exist because they're uncomfortable doesn't make them go away. It just makes you unprepared when they hit. The 2008 crisis taught us that the data gives you time if you know how to read it. 18 months from peak to Lehman, multiple opportunities to reduce risk, raise cash, get defensive. If you understood the sequence and had the discipline to act on what the data was telling you instead of what the headlines were saying, the model reads 67 out of 100 today. That's not a guarantee, it's a probability. The sequence is playing out in real time. Credit conditions tightening, labor market weakening. Leverage still elevated across the system, market anxiety spiking as reality sets in. The question isn't whether the next recession will happen. Recessions are normal. They happen regularly. We're deep into this expansion with only one brief COVID interruption. The question is whether you'll see it coming and position accordingly, or whether you'll wait for CNBC to confirm it after your portfolio is down significantly.